You spend an hour analyzing a chart. You find a perfect level of support, enter a long position, and tuck your stop loss just below the recent low. You feel entirely secure in your analysis. And then the trap snaps shut. Out of nowhere, a single sharp red candle spikes down. It bypasses the normal market flow, drops straight to your exact price level, triggers your stop loss, and closes your trade in the red. 2 minutes later, the price reverses violently. It rallies exactly in the direction you originally predicted. You had the right analysis, you picked the correct trend, but you still lost the money. It feels intensely personal. It feels like your broker is sitting in a back room, watching your specific screen, and manipulating the price just to snatch your $200. In reality, your account is simply a small coordinate in the path of massive market mechanics. To understand why that red candle spiked, you have to look past the retail trader moving 0.1 lots. We need to look at the giants, the banks and hedge funds moving thousands of lots at a time. If a major bank wants to buy $500 million worth of a currency, they cannot simply click buy at the current market price. Doing that would instantly drive the price up against them, making their own trade wildly expensive. They face a math problem. To buy a massive amount of currency without shifting the market, they need a massive group of people willing to sell to them at that exact moment. They need liquidity. For institutional players, predicting which way the market will go is the easy part. Their actual challenge is engineering enough opposing liquidity to get their colossal orders filled in the first place. So where do these institutions find a massive, concentrated pool of willing sellers? They look right below the most obvious, heavily tested support levels on the chart. These areas are called liquidity pools, or kill zones. Retail traders universally place their automated sell orders, their stop losses, just below clean round numbers or obvious double bottoms. It is highly predictable behavior. Institutions push the price below horizontal support, piercing the visible floor. This triggers dense retail stop losses, flooding the market with sell orders. They buy this influx, filling their giant position. Price immediately bounces back, leaving a long lower wick called a pin bar. Smart money intentionally shakes out weak retail hands to fuel their own highly profitable positions. Surviving the kill zones starts by taking emotion out of the equation. You have to implement quantitative defensive buffers to protect your position. We do this through padding. Instead of placing your stop exactly 5 pips below a major support line, you intentionally move it significantly lower, far away from the highest density of retail traps. The average true range, or ATR, tracks market volatility to calculate your required buffer zone. To afford this wider stop without risking more, cut your position size in half. This doubles the physical distance of your stop loss while keeping total dollar risk exactly the same. Defensive padding works because it gives the institutional algorithms the physical room they need on the chart to grab their liquidity, finish their business, and reverse the price without ever sweeping your specific account. But you don't just have to play defense. You can actually profit from the stop hunt by trading offensively alongside the smart money. The golden rule for retail entries shifts. Never place a buy order exactly at an obvious, highly visible support level. That is exactly where the trap is set. Instead, exercise patience. Wait for the market to inevitably break that perfect support line. Just let the fakeout happen. You only enter the market after the liquidity has been cleared. Your trigger is waiting for a reversal candlestick to close all the way back up inside the original safe range. Stop scanning the charts for obvious, perfect entry points. Next time you analyze a setup, ask yourself, where would I put my stop if I wanted to lose money? Then, place your entry order right there. Mastering the hunt aligns your trades with the sheer force of institutional momentum.